Insolvency doesn't need to ruin your life, but ignoring it does. I've seen directors come out the other side stronger, freer, and in control because they acted early. I've also seen directors lose their homes, their health, and the future. And it's because generally they waited too long or they trusted the wrong people. Now, you don't need to guess your way through this. You need advice, stories, real life stories. And that's what I'm doing in this video. I'm going to share powerful case studies. I'm going to talk to you about directors who've got it wrong and those who got it right. So you can follow the blueprint and hopefully avoid any nightmares. What you're going to learn in this video, well, hopefully by the end of it, you're going to understand the most common mistakes directors make under financial pressure, what actually happens behind the scenes during an insolvency, how overdrawn directors' loans, HMRC, bounce back loans, they can become traps. And I'm going to give you the red flags that show it's time to act. And I'm going to share with you the exact strategies successful directors have used to walk away clean. So you're going to leave with more than just information, you're going to leave with a fresh perspective. So before I start, it's Chris Worden. I'm from Director First. I've helped thousands of UK business owners with a whole range of business debt problems. I've been doing this for years and years, and I know how you feel because I've been there too. Now, I'm going to start with one story, okay? I'm going to start with a guy called Paul. Paul is a guy who never decided to work with us. He ran with a print business in the Midlands. His business was fairly decent before COVID, but once COVID happened, orders pretty much collapsed. He took a bounce back loan, 50 grand. He was entitled to take out the loan. He owed some HMRC arrears. He had a credit card. He had an overdraft. He owed some suppliers. And the money that he had in the business, he used it to cover payroll and bills, which was fine. But eventually, he needed to use it for personal spending. He wasn't able to make ends meet. As I've said many times, there's too much month at the end of the money. And that balance in the account kept coming down, stopped checking the bank balance, stopped opening letters to HMRC. And he thought he could fix it if he just landed one more big client. And we've all been there. He didn't even mention this to his accountant, didn't speak to his bank. He didn't call anyone. And then he received a winding up petition. And he only reached out when it was too late, the day before the winding up petition hearing. And the day after he got wound up, and the official receiver took the job. The official receiver is like a government body that will investigate the conduct of companies that have been wound up by the courts. And they saw that in there, in amongst all of this, he owed the company £75,000 in an overdrawn loan account. He had no salary records, no dividend paperwork. So when they've investigated, it was clear that he owed the money to the company and they have asked him to pay it back. And the sad story is he's actually been made to pay it all back. His wife had no idea how bad it had got. And he's now in he's in a debt management plan. He's renting a house and he's got really bad credit. The problem was he called too late. So the lesson is, listen, avoidance isn't a strategy. Speak up early. Because the earlier you speak up, the more chance we have that we can help you. Let us talk to you about another story. And let's talk to you about Karen. Everybody loves a Karen. She owned a catering company in Manchester, about a 400 grand turnover, but they had tight margins. And again, COVID come along, wiped out her business overnight. She took a bounce back loan. She used it for legitimate business expenses, but she couldn't recover. And by the time she found us, she had a bounce back loan. She had the HMRC 90 grand. A total debts for about 220,000 quid. She had the full amount of the bounce back loan outstanding because she took all the she took all the pay as you grow options. And when we looked into it, Karen had an overdrawn loan account, £19,000. And that is, well, I'll correct myself. Karen thought she had a £19,000 overdrawn director's loan account because that's what it said in her last set of accounts. So when she came to us, we said, right, okay, let's have a look at these accounts. Well, what's happened since your last set of accounts, Karen? Well, she continued to take in money out of the business. She had to feed a kid. She had to pay a mortgage. She had to pay other bills. Listen, I'm not here to judge. like she was scared, she was ashamed, she was exhausted, and she reached out and I said, right, let's get into this. And we worked out that a director's loan account had almost double. We flagged that. And what we did is she had no other option. A winding up petition was imminent. So we spoke to the insolvency practitioner and we basically put together the full pack of where Karen was, how much a house was worth, what the mortgage was on it, what the available equity was. Karen had a husband. Even though she had a director's loan account because her husband wasn't involved in the business, an insolvency practitioner couldn't go after his equity. And we basically put together what her income was, what her expenses was, and we showed the insolvency practitioner, listen, in a bankruptcy, you would get nothing from Karen. She'd be out of a home, she'd be made bankrupt because she had credit card debts, loan debts. So what we're saying to you is listen, she is willing to offer us a lump sum, £7,000 on this director's loan account. And we think it's the best offer that you can get. The IP looked at it and went, you know what? They checked it. And you've got to remember the rules here is they can only agree to an offer in principle. Because once they get appointed as the liquidator, they've got to verify everything that we're saying to them. And obviously, if they find out that Karen's assets were worth more than they were, or she stashed away a villa in Marbella, that deal gets ripped up and the gloves come off. But obviously, we do the hard work, what other companies aren't willing to do without charging you. And we got this deal accepted. And that allowed Karen to move on with her life. She was able to sleep better at night. Yes, it cost us some money, but it's done and dusted. Now, I would say there are 3 common mistakes that I see time and time again through directors who get it wrong. Obviously, mistake 1 is the ostrich method, burying the head in the sand and they wait too long. They ignore letters from HMRC, don't want to speak to the creditors, they are dodging phone calls, don't want to deal with the banks. And the idea is next month we'll fix everything. And I'll tell you how I know that, because I was that guy. Like literally, I remember when we had to go through insolvency, I remember owing HMRC money. And I remember I just did not want to speak to him. I was frightened to death of speaking to someone at HMRC, especially with bad news. I was that type of guy. I don't mind calling you if it's good news, but to tell you I haven't got your money, again, scared the life out of me. So much so, I mean, it's an embarrassing story. I remember a HMRC enforcement officer turning up at our office. I obviously told the staff to tell them I wasn't in. Yeah, I did that. But here was my solution to that, okay? Didn't bother speaking to my accountant, definitely didn't want to take any insolvency advice. What I did was put a keypad on the door so the next time that they come, they just wouldn't be able to come into the office. Listen, that is how naive I was. It was many, many, many years ago. Because I always had in my head, you know what, I'll sort this out, I'll figure it, okay? Now, when you're going through that type of problem and you're ignoring creditors, your cash flow's tight, it's important, right? As soon as it does get tight, is you get advice. And not always just from your accountant. You want somebody who knows about insolvency. Because if your accounts are done by your accountant at the year end, the chance that they might not even know you're in this type of mess. Remember, it's really important to have accurate information, sort of at least on a quarterly basis. I'd say you need it on a monthly basis. So you know what's coming in, what's going out, and you can make decisions on your business on current information. Listen, mistake number 2 is they're taking money out of the company the wrong way, okay? So let's talk about what's the right way. Well, that depends a little bit. And it depends on whether your business is making money. If your business is profitable, you will be told the best way to take money is about 12 grand a year of salary and you top the rest up as dividends, right? Now, I want to be really clear. You don't pay yourself a dividend. You take, I always use this example, 4 grand a month through salary PAYE. You take 3 grand a month in anticipation of a dividend at the end of the year. The end of the financial year, you go and see your accountant, you let them do their books. They declare the dividend, you pay the tax, you pay the personal tax. Now, the problem is if you become insolvent, well, what does that mean? You can't pay your debts when they fall due. Your liabilities are more than your assets. If you're in a time to pay arrangement with HMRC, it's a clear sign you're insolvent. Well, if you're insolvent, you've got no profits or you've got less profits than you used to have. And if you continue to take money out of that business and at the end of the year, your accountant cannot declare enough dividend profits to declare the dividend, what they're going to do is they're going to convert that money that you've taken into something called an overdrawn director's loan account. You're going to get taxed through the nose if you keep the company trading and it goes, let's say it's over £10,000, you don't pay it back within 9 months. I'm sure someone's going to correct me. I think the tax is 33.75% on your corporation tax. Please don't shoot me. I'm not far off there. And if you go into insolvency, an insolvency practitioner is going to ask you to pay the director's loan account back, which is really, really problematic, especially if you've probably not got the money. So what's the fix? Well, you've got to declare income properly, right? If your business has started to struggle, and you know that because you can't pay people, but you'll see this quicker if you have monthly management information that's showing what money's coming in, what money's going out. If you've got a cash flow projection, next 13-week cash roll showing what you got due in, what you got due out. And you can see this earlier. Now, the minute you start to become insolvent, my suggestion is, first thing is you change the way you pay yourself and you convert from paying yourself small amount of salary to salary and drawings to all salary. Now, you can't take the Michael. If your drawings are 40, 50 grand last year, you can't start paying your salary that equates to £100,000. That'll get you in trouble. But speak to your accountant, say, I'm worried about a director's loan account. Please, can we just go on to salary for the time being? Yes, you're going to be taxed at source, but it's not going to leave you with a nasty overdrawn loan account that needs to be dealt with once you go into liquidation, or if you go into liquidation. Listen, mistake number 3, you trust the wrong advisor, okay? Everybody has met that knobhead in the pub, okay? Who tells you what he's done in the past. And he's the type of guy who doesn't just give insolvency advice, he gives love advice, he gives relationship advice, he gives investment advice. We all know that chap. Don't listen to him, okay? Or you're one of those people that goes out there, you don't really know a lot about insolvency, and you're going for the cheapest quote when it comes to liquidation. And I see this all the time. Listen, a good liquidator really, today in 2025, they're probably going to want 7 grand plus VAT for a basic liquidation. And that cost has gone up. I used to tell you it was 4 grand plus VAT, but everyone's so busy. Like with us, basic liquidation is going to cost you 5 grand plus VAT. You've got employees, you've got complications, that's going to go up, right? Anyone who's quoting you 2 grand plus VAT, right? There's something going on there. And I'll tell you what they're going to do. They're going to make up the money that they're going to charge you at the back end. They're going to find something against you. It's going to find some type of spurious action, okay? Whether that's an overdrawn loan, a misfeasance claim, whatever it is. It might not even have any merit, but they're not doing a job for 2 grand, okay? You're better off going with somebody who tells you everything up front, like we do. We'll get listen, we scare directors. Yeah, sad but true, because they think that they've been told this is going to be 4 grand to wrap up. And I get in there and go, well, actually, you've made a preference payment there. That could be overturned. You've got a director's loan account of 100 grand. Well, you're probably going to have to pay 60 grand back. And they've got me saying this is going to cost you the best part of 70 grand. And someone else saying it's going to cost 4 grand. It doesn't, well, one of us is not telling the truth, okay? Go and have a look at my reviews. I tell the truth. I tell the truth even when you don't want to hear it, even when I'm telling it and I'm like, ouch, I know this is painful to hear. But I believe that you're better off knowing everything first so you can prepare for it, okay? So what's the fix? Well, the fix is to find someone who has got a really good track record. There's not just me who's great out there. I am fantastic. Please go and have a look at my Trustpilot reviews. I am number 1. My team is number 1 for corporate insolvency advice. And there's a reason for that, okay? We do a bloody good job. Our model is to advise you, the director, of what you can do and what you can't do. But there are other good firms. You know, have you got a good recommendation from your accountant? Have you spoke to more than one liquidator? Even if you're speaking to me, I still suggest you speak to somebody else. But you've got to get everything in order before you make decisions on this. You want a full proposal of all costs. You want to be working with an insolvency professional that's asking you lots of uncomfortable questions. Because guess what? It's better to be asked them early and you can answer them as to once you've appointed. Because remember, once you've appointed a liquidator, there's nothing you can do. You're in bed with them until they finish with you. Okay? one of the things I want to sort of talk to you about is there are advisors out there, and I'm getting it a lot, that say, Chris, I know what you're saying, but I've had someone offer to buy my business. I had it yesterday. The company owes £500,000. We're sort of going through what an admin might look like, and they're considering selling their business. So this is what happens. They sell this business to a company. They have to pay this company 15 grand to buy the business. Does that sound right? Listen, it's absolutely nonsense. Very, very rarely is somebody going to want to buy your debt-ridden business. Please, please trust me on that one. Obviously, if it sounds too good to be true, it generally is. Okay, don't be stupid, don't be duped. Be reminded that in April or May 2025, when this video goes out, you can't strike a company off with a bounce back loan or a C-bills. There's still people out. I spoke to a bank the other day, and they advised to call this company. I was calling on behalf of the client. This company that the bank advised the client to call, advised them to strike the company off with a bounce back loan. You can't do. The bank will object. You'll be stuck in limbo. It's not a good scenario. Sometimes the best solution, if you can't afford to do anything, is not to do anything. But don't try and strike a business off that's got a bounce back loan. Obviously, I want to talk to you also about stories that work here. Okay, let's talk about Lee and Dan, two directors. They were a logistics firm in the Northwest. Big COVID fallout. Fuel prices crushed the margins. They were behind on VAT. They'd taken a C-bills, trading at a loss. Instead of hiding, though, they picked up the phone and we helped them. Okay, we got in there. We helped them buy their assets back. We got their assets valued by an independent valuer. They then made a new company and bought those assets back for a fair market value. They had some directors' loan accounts that were overdrawn. We helped them calculate what their DLAs was as of the day of stopping trading. We told them to pause all unnecessary payments, okay? And then we helped them prepare for their liquidation, okay? One of the insolvency practitioners could come in who we worked with for years and years and years. We basically showed the directors what was going to happen. The directors could sleep better at night. When we first started speaking to them, we told them to start taking board minutes of their decisions. The insolvency practitioner looked at this. They understood that the purchase of the assets was a fair value. There's no threat of any action. There was a settlement made on both directors' loan accounts. It were agreed in principle up front. It was paid immediately upon appointment. And both directors got a clean break. You know, they're back in business under a slightly different model. And the lesson is when you act early and tell the truth, you can walk away with dignity. Sometimes you can even come back stronger. So this is what we do, right? The director first protection plan, right? If you're under pressure right now, follow this process. One, audit your business. Where are you at? Who do you actually owe money to? Okay. Not what you think you owe them. Get balances. Exactly. We don't want to see this worse than it is. We want to see this as this is. We need to understand, you need to understand, sorry, your balance sheet. Okay. What is your balance sheet at right now? What do you hold in cash? What you got money due in? How much your assets worth? Are your liabilities more than your assets? If they are, you're insolvent. If you can't pay your debts when they fall due, you're insolvent. Okay. Have you got any personal guarantees? Have you got, go out there, find out with the overdraft, find out with the credit cards, find out with the loans, find out with the suppliers. Have you signed any PGs? If you are, and you're going to end up in insolvency, what is your plan to deal with those personal guarantees? Again, we can assist you with that. Step 2, stop the damage. Okay. So if you don't feel that you can recover from this, stop trading. Stop trading, pick the phone up, get some advice quickly. Stop taking drawings, okay? Anything you take that you call as a drawing. Listen, you can take a salary. You can't take a drawing if you're insolvent. If you take it, you're going to be asked to pay it back. Don't make preference payments, okay? And it leads up to step 3. Get some bloody help. You need someone who's direct to focus, who's got a really good track record of helping thousands of directors with these types of problems. Do you know anyone? I know a funny-looking bold chap from Preston who's been doing this years and years and years and has a fantastic reputation. And then you've got to pick the right process. Is it a liquidation? Liquidation is generally a full stop. You know, business is over. Yes, you can buy some assets back and you can start again. You know, is it an administration? Is there a going concern? Is there some real good parts of this business that can be hived out, or the staff that needs saving? Is an admin the right option for you? Is a CVA the right option for you? CVA is where you put all your unsecured debts into a pot and you pay it over an extended period of time, generally sort of 60 months. Again, these all have different consequences. I'm not asking you to make a decision on the back of this video, but what I'm telling you is we can help you choose the right option based on your situation. And step 5, listen, stop beating yourself up, right? You're not a failure. You're not a fraud. You're in a tough spot. I've been there. And there is a legal framework that allows you to get through it, hopefully fairly cleanly, and you start living your life. So I hope you found this video helpful. I offer free and independent advice. I've got a big team behind me. We have got fantastic reviews. Remember, it's not insolvency that ruins you. It's the delay, it's the silence, it's the wrong advice. And if anything's hit home in this video, like the video, subscribe to the channel, download our free insolvency cheat sheet, book a call, confidential call, no pressure, just answers. And come and join us again, because we give tactical, emotional and honest videos every single week. My name is Chris Worden. Thanks for your time. God bless you.